Good morning. Good morning, everybody. Thanks for your time today. Thanks for having us along. I'm Ross Travers, Business Development Manager in the Southeast for Transact, joined today by Mark Fenlon, who's Head of Technical Services. So I'm just going to spend a few moments talking about what we do, where we've been, where we're going in terms of the platform, outlining some of the strategic elements that are in play. And then Mark's going to cover off the technical element, which to make the content as CPDable as possible and give you as much value add today as we can. If anyone has any questions, please let us know or pop them in the chat. I'll certainly keep an eye on the chat when Mark's talking, and at the end, I'll ensure that I'll circulate the CPD to Mohan at the end for everybody. But just in a sense of Transact, for those that may not know too much about us, we were first platform to launch back in 2000, so we've been going for kind of 25 years. That's a continuous kind of improvement of development, shaped predominantly by advisors. We take on a lot of feedback. A lot of the, some of the best suggestions over those years have come from advisors and their staff. So please don't be shy if you think that something's missing that you would like to see. We're on kind of release number 492 of the platform now. So although proprietary technology is a massive advantage, it's no longer exclusive to the market, but certainly we're operating at a scale far in excess of anyone else running proprietary technology at around 80 billion, given our kind of longevity in the market. Service is massively important to us. Within that, we own our own tax wrappers, which gives us a hell of a lot of control. Certainly around some of the things we're going to touch on today, ownership of life companies for on and offshore bond is obviously proving very fruitful in the current market. Regionalised servicing teams is a big factor for us, giving you continuity when you have to contact us. Within those teams, we have people placed in specific areas of the high traffic areas mainly, so transfers, compliance and technical, and legal. So when we're dealing with expat cases, they can be, sometimes not straightforward, and certainly trust work is very, very, very popular at the moment. So we have specialists in those areas to ensure one point of contact. And in terms of price, we continue to reduce price annually. The price reduction for this year centres around a widening of the family linking policy, which plays very much into our sweet spot at the moment in intergenerational planning. And in terms of what that looks like, that will be an addition of nieces, nephews, siblings of partners, brothers, sisters, so they can all form a link without the need to necessarily have a grandparent or a parent above that to kick off the family chain. So that's it's been well received by advisors. In terms of the functionality, which sits under the bonnet, which is obviously the heart of why we're so popular with advisors, we're pretty much covering off, I think, every area that you would expect us to and more. I won't need to touch on the fact that we've got a GIA, an ISA, and a pension. I will mention we have got a Section 32, which is extremely rare. We also are involved in LISAs, again, not majorly available in the platform space as a whole. Particular focus at the moment on and offshore bonds. As I mentioned, we own those life companies, so you've got ultimate flexibility and one reporting line. If you are placing, the pension, the ISA, the GIA, and the bond with us, that's going to be one reporting line. Towards the right of this slide, you'll see some of the more funky stuff, which certainly isn't available elsewhere in the market. So we are involved in expats. Depending on the risk of the jurisdiction, we may ask you more questions than some others, but I think that's to be expected. VCT, structured products, we do our fair share of that type of business. And we've touched on the trust element, which is very, very popular at the moment with Transact. AIM ISA, direct gilts, direct shareholdings. We don't just deal with LSE sterling denominated, so you could kind of tap into overseas markets as well if looking to buy direct shares, which largely probably a small percentage of what we do, but for the right type of client, that can be a deal breaker. So it's worthy of mention. So we've pretty much got everything covered off from a functionality perspective. I just wanted to touch on some of the service elements really, which make up the personalized factor. So we're very much sticking to a people-based approach. the rise of AI may mean that people assume that we're going to be plugging in robots to pick up the phone to advisors and their staff. We're deliberately staying away from that, and you'll see on the screen here. So in terms of the field support, you've got myself and Sam Patterson would pick up the training or any kind of areas of the platform you may not be uncertain on. The regional team, we touched on the specialists, so that's one point of contact in London, kind of picking up the phone in kind of 10, 12 seconds. So you've got that, facility. That goes a long way. It's one of the things that advisors mention quite a lot to me when I'm out and about. Just the simplicity of someone actually picking up the phone goes very far these days. And then online support. If Sammy or myself aren't around, you've got the option of live chat facility or co-browse. Again, the live chat is not it's not a robot, it is a human, so you will get kind of a comprehensive answer, and they can jump on and share screen with you if necessary in terms of a co-browse. And worthy of mention, obviously, given Mark's here today, the technical team, they are not in ivory towers, which is evidenced today, but also if you need to contact Mark's team for, do I need a transitional tax-free cash certificate, which is the best way of segmenting a bond, that's the stuff that we are happy to get involved in and do as a matter of course as part of the overall service proposition. So please don't be afraid to contact those guys as well. But I will stop sharing there. Essentially we feel we've got a great mix of functionality, control, mix of wrappers, all at a valuable value for money price in the market, and that's still proved very popular with advisors. Our flow numbers for last year were around about 4.5 billion. As I mentioned at the start, it's a very competitive landscape, and we're not resting on our laurels. So we'll continue to drive up the activity around integrations. Service will never go away, and we're massively focused around that. And we're just at the point of boxing off the final elements of digitization on the platform, which again has probably been the biggest shift as an advisor would have seen over the last 3 or 4 years. The move from kind of 100 bits of paper to do anything on Transact, which is we're still going to try and shed that tag in the marketplace, to having a fully onboarding journey, plus all the functionality elements that you would need across a week or a month of business. That's now all digital, and we're very close to completing that with just the trust work to do. So without further ado, if there's no questions at this stage, I will hand over to Mark to cover off the IHT pensions element of the session. Over to you, Mark.
Thanks, Ross. Right, so I'm just going to start sharing my screen. Bear with me a moment as we do this little transition very professionally. And I know if we start the slideshow, here we go. So hopefully you can see the opening slide there. So, oh, we're getting a bit ahead of ourselves. So my name's Mark Fenlon. I'm Head of Technical Services at Transact. This morning I'm going to be talking about what we think IHT planning is going to look like in a post-budget world. And if you're wondering which budget, because we've had a few, this is in relation to, of course, the IHT changes that were announced in the autumn budget 2024. Now, some of these will come into effect in April this year. These would be the changes in relation to agricultural and business property relief, currently subject to 100% relief for qualifying property, but that's going to be restricted from April. Originally, the tax-free threshold was going to be £1 million, but the government have done, some would call it a U-turn. And now that threshold's been increased to 2.5 million. So that was good news. Anything in excess of any property in excess of the 2.5 million still gets relief, but only at 50% of the standard IHT reliefs, IHT amount. So relief would be at 20%. Also coming into effect from April is the fact that qualifying AIM shares also lose their IHT exemption, but they still get relief 50% of the standard IHT charge. So that would be also a charge at 20%. But of course, the big change, the fundamental change, is due in April next year. And this was the announcement that unused pension funds would be included in a deceased estate for IHT. And this is, I've been around a couple of decades, and this is certainly one of the more fundamental changes to pension tax that I've seen. It really does turn IHT planning on its head, because not only is the value of the estate going to increase by the pension, we know for a lot of our customers, the pension was their kind of main IHT planning vehicle. So they've got to deal with a bigger estate and the fact that their previous IHT plan now isn't going to work. Now, we've done some work with a company called Trajectory to see how many households we think should be thinking about their IHT position. And I've got this slide here, which I'm just going to get a pointer up so I can talk through the relevant bits. Here we go. So let me explain what we're showing here. This is a graph that shows the number of British households that have household wealth in excess of the available nil rate bands. Now, because we're talking about households, we're assuming a couple, married couple, civil partnership, where a nil rate band can be transferred from first death to the survivor. So we're making use of the both nil rate bands. And if you go back to when the research started, the first cohort was from 2006, 2008. And back then, it was round about 6% of British households had household wealth in excess of their available nil rate bands. That starts to increase from around about 2009 when the nil rate bands are frozen. So by the time we get up to wave 5, 9.4% of households have household wealth in excess of the available nil rate bands. Now, at this point, we have the introduction of the residence nil rate band. And assuming there are no changes, we end up back in wave 8, back down to 6% of households who have household wealth, excluding pension benefits that are greater than the nil rate bands available and the residence nil rate band. You add on pension wealth, though, into wave 8, and that number of households increases from 6% to 18.8%. So what we're expecting is for the number of households who need to think about IHT planning to broadly treble. So a much bigger section of the population should probably take IHT planning advice. Now, not all pension benefits, unused pension benefits, will be included in the estate. There are a narrow range of exemptions. Firstly, any payments to spouses or benefits set up for a spouse, they would be exempt. Charity lump sum death benefits also exempt, as are dependent scheme pensions. So those are the scheme pensions typically set up by a final salary pension scheme. Death in service benefits are also exempt. There was some confusion with the initial announcement about whether they would or wouldn't be included. But a scheme that's set up, even if it's set up using kind of pension regulations, if the only benefit it provides is a death in service benefit, then a payment from that scheme would be exempt. And also we've had some clarification on the fact that a pension from a joint life annuity set up on second death, that would also be exempt, even if it's for a non-spouse. Although any money through value protection or guaranteed periods, that would need to get included in the estate. So what action can be taken to help mitigate the position? Well, the first thing that's worth mentioning is that before taking any action that's irrevocable, obviously required a fairly detailed and considered looking at the customer's background and circumstances, because what we do know is that, and what we've seen is that regulations change and they change fairly frequently. So it's difficult to predict what's going to happen in the future, particularly around this piece of legislation, which is quite, I think, controversial. There are some simple measures that could be taken, though. The first one might be just to update an expression of wish to make use of a spousal exemption. Now, What we see on our platform certainly is that quite often couples who join our pension schemes don't automatically nominate each other on an expression of wish for IHT benefits from a pension really to flow through. It usually makes a deal of sense to actually nominate perhaps children or other issue. So in circumstances where a spousal exemption would be available, it might be worth updating an expression of wish to nominate a spouse. That's not a silver bullet for the problem, of course, though, because you might just be creating a larger problem on second death, but it might buy a bit of time whilst a more robust IHT plan is put in place. A second thing to consider would be taking out any tax-free benefits before death, particularly once a client reaches age 75. And we're talking typically here about perhaps PCLS tax-free cash that hasn't been taken once a client gets to age 75. Under the current rules, there is an argument for keeping the tax-free cash in the pension because it's exempt on death from IHT. It would be subject to income tax in the hands of the beneficiary, but that could be a lower rate than the IHT that would otherwise be charged. But of course, April 2027, when the new rules around IHT kick in, then a PCLS not taken by a member once they reach age 75, on their death it becomes subject to IHT and income tax. Whereas if it's withdrawn from the pension, it would just be subject to IHT. So I think that probably gives a reasonably good basis for taking any tax-free cash by a client by the time a client gets to age 75. And of course, we're not just talking about tax-free cash here. It could be tax-free income that's being paid to a beneficiary because they've received those benefits from an individual who died under age 75. So their payments are tax-free. What we're also getting a lot of questions about is whether pension income can be used and gifted to individuals to qualify under the normal expenditure out of income rules, and certainly that can apply. The basic rules need to be adhered to in that the gifts need to be habitual, so it's important that the pattern of gifting is established over a number of years, maybe 3 or 4 years, just to set up that kind of habitual pattern. They need to be made from surplus income. So what we're talking about here is, if you analyze the client's expenditure year on year and their income year on year, any difference, any surplus on the income side could be gifted, and then it would qualify under this rule of surplus income. And of course, in the gifting, it mustn't diminish the settler's standard of living. For individuals who are hoping to make use of this exemption, then it's really important that good records are kept. Without establishing these records during the life of the settler, it's going to be really difficult for executors or personal representatives to piece it together afterwards. And we do have gifting logs on Transact Online that can be used for record keeping. And this is just an excerpt from the log, but it allows for records of income to be maintained and expenditure so that a surplus can be calculated and then a note of the gift. And this kind of mirrors onto the IHT form that would need to be completed by the executors following death if this exemption is going to be claimed. So this is a log that's available on Transact Online, and it can just be downloaded. But as well as gifting income from a pension, clients might want to consider gifting capital, because the fact that pensions are being included in the estate for IHT isn't just a problem specific to the pension, it's a problem to the estate as a whole. And generally speaking, for clients who want to reduce their IHT liability, then making gifts of capital can also be a sensible idea. Gifting to individuals or to bear trust certainly has its appeal. And once the gift is made, then there's no ability, though, to alter it. So if you're gifting to an individual, the money's gone, you've lost control of it. If you're gifting into a bear trust, then arguably you have some control over, or the settlers would have some control over the investments, but fundamentally the with a bare trust, the beneficiary is established at outset, their percentages are established at outset, and that can't be varied. And that kind of loss of control might not be appealing to some settlers, so they might want to consider using discretionary trusts, which give them and the trustees far more flexibility over the timing of the payments to the beneficiaries, and also the amount of beneficiaries. And obviously, there'll be a set of trustees who continue to operate the trust following the settler's death. The IHT position between a bare trust or a gift to an individual and a discretionary trust are obviously very different, with gifts to individuals and bare trust being potentially exempt transfers, whereas a gift into a discretionary trust will be a chargeable lifetime transfer. And that will mean with a gift into a discretionary trust, once the total gifts or the total chargeable lifetime transfers exceed the nil rate band, 325,000, looking at a 7-year accumulation period, then there is an IHT charge, a lifetime IHT charge on the excess based at 20% of the excess. Also with discretionary trusts, you've got periodic charges applying, broadly speaking, at 6% of the trust property value above the nil rate band. And then exit charges can also apply. For individuals, for settlers using a discretionary trust, so income tax and capital gains tax is also applicable on the assets at the rate applicable to trust, which tends to be the additional rate for income tax and the higher rate for capital gains tax with a reduced CGT allowance. Of course, what we see on the platform is the vast majority of the trust applicants using either an onshore bond or an offshore bond, which in the hands of the trustees is a non-income producing asset. So it cuts out all of the tax reporting that needs to be done had the trustees invested using a GIA. It also makes distribution of benefits a little bit more straightforward, because it's possible just to assign segments of a bond straight out to beneficiaries, who can then encash those segments at their own marginal rates, which typically would be lower than the rates applicable to trust. So that's a really useful tax benefit too. So just moving on, this is the kind of standard model for a discretionary trust. You have the settler who makes a gift. The gift goes into the estate and it sits there with the growth and the income. On death within 7 years, the value of the gift is dragged back into the IHT calculations. But after 7 years, the value of the gift would be completely outside of the estate. Then you've got the growth and the income that's immediately outside of the estate. And then in accordance with the rules and powers granted to the trustees, they can make payments to beneficiaries. But usually with this standard model, the settler is excluded as being a beneficiary. And just going back to what I said earlier about taking action that's irrevocable, setting up a normal discretionary trust is exactly that. Once the gift has been made, the settler is excluded from benefiting and they lose access to the trust property. And that could be, unappealing, I think is probably the word I'm looking for, to a lot of settlers who might wonder whether, if they make the gift, whether they'd really, maybe in future years, maybe they'd actually need access to some of that trust capital. And there are a variety of trusts that are available that could be set up on a discretionary basis that do allow the settler access to the capital. And the three main ones that we see being used are, firstly, loan trusts. Loan trusts are a very light form of a trust. What we offer within our suite of trusts is what we call a gift and loan trust, where a relatively small gift is made, usually £10. It could be higher, it could be 3,000 to make use of the annual exempt, or 6,000 if there's 2 years worth. And that small gift would be immediately outside of the estate. But then they make a much, much larger loan, maybe several £100,000. And the loan is repayable on death or demand of the settler. But any any increase in the value of the loan through capital appreciation or income, that's all outside of the estate. So the fact that the loan can be repaid at any time means that the settler has the comfort of knowing that yes, they've taken some action to reduce their IHT, potential IHT bills in the future, because all of the growth and income on the loan is outside of the estate, but they've still got access to the capital. And quite often what we see with a gift and loan trust is that the loan is repaid steadily over a period of years, usually making use, because just going back to what I said earlier about typically trusts using bonds. Typically, this type of scheme, the trustees would take out a bond and they'd think about using the 5% tax deferred withdrawals to repay the loan. They don't have to do it regularly. They could even, the settler could, once they're comfortable that they won't need the loan, they could make a gift of it at that point in time. But at that point, the value of the outstanding loan that they're gifting would become a pet if it's a bare loan trust, or it would be a CLT if it's a discretionary loan trust. So there's a lot of flexibility with loan trusts, and I kind of consider that a fairly light version for IHT planning. We've then got discounted gift trusts, very different to loan trusts in as much as that with a discounted gift trust, the settler sets out how much they want to receive back in payments from the trust each year, and that's a fixed amount that's payable to them for life. So they have this regular flow of capital going back to them out of the trust. Because the amount is fixed for life, the amount that the settlement value that goes into the trust initially is reduced for IHT based on a rough calculation that takes into account the capital cost of those flow of capital payments back to the settler. And I've got an example of how that looks in terms of a settlement value and what the actual discount looks like. And then we've got flexible reversionary trusts. In a similar way to a discounted gift trust, they allow for regular amounts to be paid back to the settler, but the trustees have the powers to defeat or defer those payments to at some point in the future. So it's a bit like a discounted gift trust in the fact that regular payments can go back to the settler, but if the settler doesn't want them, the trustees can defer the payment or defeat it. So it gives you that little bit of extra flexibility over a DGT. But because the trustees can defeat or defer the payments, there's no discount. So the full amount that's paid into a flexible reversionary trust is the amount that's gifted for IHT, and it doesn't benefit from that discount. So just looking at the kind of model of what a gift and loan plan looks like, we looked at one for a discretionary trust. So the gift and loan, we'll assume this is a discretionary trust as well. The settler makes it a gift. Usually it's fairly small, and they make a loan. The outstanding loan remains repayable to the settler either on death or demand, so they can set up regular loan repayments. The beneficiaries can receive payments from the trust at any time, subject to the trustees maintaining capital to provide the outstanding loan. Now, this is like I mentioned earlier, is a fairly light version of a trust. And when looking at using a gift and loan trust, the benefits for the estate tend to materialize over longer periods of time. And this example sets out exactly how much a loan trust could help reduce the value of estate over time. What we're saying here is that in this example, a loan is made of £500,000. We're going to assume growth at 7% per annum. What you can see at the end of year one is that the value that's outside of the estate is this top bit here is relatively small. And underneath this line shows over time the amount of loan that's due back to the settler. But over time, you can see, based on a 7% growth, the amount of the clients or the benefit to the estate can be quite dramatic. After a 20-year period, the reduction to the estate is about £1.5 million. So whilst it is a light version of a trust, it can still be powerful if the loan trust is kept running for an extended period of time. For clients who actually want to have that regular payment going back to them, then it's probably worth them considering the discounted gift trust, though, because of the discount. The model is slightly different. The payments for life to the settler have to go out as set out in the schedule. But as I mentioned earlier, as a result of those guaranteed payments going back to the settler, the amount that's paid into the trust is reduced for IHT purposes. Here's an example of how that might work in practice. In this particular example, we'll assume that we've got a widowed individual who's currently age 70. They've got a house worth £1 million. Currently, they have an uncrystallised pension pot valued at 800,000 and an ISA worth 400,000 and cash and other investments of 400,000. Now, currently, they don't take anything from their pension because why would you? It's quite an effective tool for IHT for another year. But she does draw income from her ISA and investments of £30,000 per annum. So what does that mean from a current IHT perspective, and what will it mean come April 2027? Well, currently the estate subject to IHT is 1.8 million. And if we assume that there's nil rate band transferred to this widowed individual, that means they've got a nil rate band of £1 million. But come April 2027, their estate's going to be valued at £2.6 million, which puts it over the 2 million for tapering. So actually their nil rate band would reduce by £300,000, as well as the fact that they've now got to include this uncrystallised pension in the value of their estate. So what action could the client take? Well, they could make a settlement. They could make a payment into a discounted gift trust. In this example, we'll assume the amount they pay into the DGT is £600,000. Now, as part of the process for applying for a discounted gift trust, because there is a discount that's based on the capital payments that are going back to the settler, then it's necessary to make the trust robust from a tax perspective for the settler to undergo underwriting to demonstrate and provide evidence of their health. And at Transact, we cover the cost of the underwriting. That's part of the standard procedures for discounted gift trust. But we're going to assume in this example that she's in good health, this particular client. They've got a settlement value of 600,000 and they want regular payments of £30,000 each year to go back to replace this income they're currently receiving. Now, given that the client's in good health and the fact that they're taking £30,000 a year, then this settlement value, that the amount they put into trust, the amount that's applicable for IHT is only 303,000. So it's below the 325,000 nil rate band. So if this client was using a standard discretionary trust, a settlement of 600,000 would attract a charge of 20% on the excess above the nil rate bands. There'd be 275,000 subject to a 20% charge. But because they're using a DGT, that charge doesn't materialize because the value for IHT is under 325,000. That gives us a discount from the total of 49.4%. What does this mean in terms of IHT savings? Well, if we look at the IHT position pre-April 2027, they've got a home worth £1 million, their ISA's worth 400, GIA and other investments is 400, so their total estate is 1.8 million. Now their pension's excluded, but they get 2 nil rate bands, 650,000, 2 residence nil rate bands of 350,000. So that gives £1 million to reduce the 1.8 million taxable estate. So their IHT liability at the moment be around about £320,000. Now, including the pension, which will be the case from April 2027, what we see is the value of their estate jump up, the estate subject to IHT jump up to 2.6 million. We can knock off 2 nil rate bands, but the residence nil rate band has reduced to £50,000 as a result of the tapering, which means they're kind of taxable. The amount of the estate that's subject to IHT is now 1.9 million, giving an IHT liability of 760,000. So that's an increase in 440,000 for this particular individual. But what happens after the gift into the discounted gift trust? Well, they've still got their home and ISA valued between them at 1.4 million. There's nothing left in the GIA because we're going to assume the gift is made from 400,000 from the GIA, and the pension's reduced to 600,000 because we're going to assume that the tax-free cash has been taken and that's been gifted into the DGT as well. And what does this mean for the estate total? It's fallen for IHT purposes down to 2 million. The residence nil rate band is now restored in full, so that means the taxable estate is reduced to £1 million. The IHT liability is £400,000, so still higher than it was prior to the changes. But the IHT saving compared to not taking the action is 360,000. Now, it is true, of course, that if this individual dies within the first 7 years of having making the gift, then some of that value will be pulled back into her estate for IHT. But the discount that was secured is immediately outside of the estate. And of course, the impact of making this gift means that the residence nil rate band is restored in full, irrespective of whether or not at some point in the next 7 years, part of the settlement value is pulled back into the estate, because that doesn't come into play for calculating the taper for the residence nil rate band. So using this strategy, in fact, using any trust strategy has that benefit in terms of the residence nil rate band. So I also mentioned that flexible reversionary trusts are a good way for a settler to set up a trust and retain access to trust property. Now, we don't offer a flexible reversionary trust, but there are other providers who do, who then go on to use our GIA to manage the investments. So advisors are kind of recommending other providers. I won't say any names. Hopefully, if you work in this space, you'll probably know who I'm talking about. But we do allow for third party, typically it's bond providers, to use our GIA for advisors to manage investments. So we see this happen quite frequently. But we are, if any of you read the Citywire article that went out last week, I think it was, we are looking to launch our own specimen wording for a flexible reversionary trust. And that will probably be around about May, June time this year, maybe a bit later, maybe a bit earlier. I don't want to get caught on a date. But as I said earlier, these provide additional flexibility over the discounted gift trust, because a schedule of payments to go back to the settler can be set up from the outset. And just prior to those payments falling due to the settler, the trustees can say, well, actually, no, we're going to defer this payment for another 10 years or 15 years or 20 years. Or they can say, well, no, we're not going to give it to you. We're going to pay it to another beneficiary. So the trustees have quite a lot of power there. Once a decision needs to be made, though, before the date of the reversionary interest is due to fall back to the settler. After that point, it's too late, because typically the way these trusts are structured and the way our trust will be structured is once the settler gets to the date that the reversionary interest is due, then it gets paid and that's it. There's no going back. So prior to any decision prior to the date arising, a decision needs to be made between the settler and the trustees, and it's really important that that decision's documented. So again, good record keeping for this kind of trust is essential. Here's a kind of an example of how a flexible reversionary trust might work. A settler paying 325,000. The market research we've done on flexible reversionary trusts suggests that this tends to be about the mark at which they're used. It's not common for a settler to pay more than 325,000 because of the lifetime charge that would be applicable to the excess, but typically an amount up to the nil rate band is gifted into a trust. We're planning that the trust will then have 1,000 segments. And so the settler could say, well, actually, what I'd quite like is for 50 segments of the trust to be returned to me at each anniversary. And if they did that, then they could set up a schedule that for the next 20 years, they'd have 50 segments returning to them. Now, what we're not expecting to see is for a trust to be set up on that basis and then for the payments to actually go back to the settler. Because if the settler really did want those payments, they would be better off using the DGT and securing the discount that would come with it. But what we are expecting is for a trust to be set up this way, and then for the settler and the trustees to agree that actually they don't want the payment. But the option to take it is always going to be there. And that's kind of the safety blanket that we think is important, that, or we think is the reason why these kinds of trusts are popular. The capital can go back, but more often it's just a feature just in case. And the expectation is that it wouldn't get paid. What's the IHT position? Well, the 325,000, typically FRTs are set up as discretionary trusts, as will be a discretionary trust. We won't have a bare trust version. It will be available for both the onshore and the offshore bond. The amount paid in this example, 325,000, it's a chargeable lifetime transfer. So it's fully outside of the estate after 7 years. The periodic payments, for periodic charging purposes, the amounts that are paid back to the settler aren't distributions, so they don't get caught up in the calculations for periodic charges or exit charges. And exit charges don't apply to the amounts that go back to the settler either. In terms of which type of trust has the most immediate impact in reducing the value of the estate, I've got this chart here to show a comparison between the flexible reversionary trust, a loan trust, and a DGT. So this grey line's the DGT, and the pink and green line here is the loan trust and the flexible reversionary trust. And what you can see from day one, the DGT has the biggest impact because the discount is immediately outside of the estate. For both the FRT and the loan trust, the trust property typically falls back into the estate on death within 7 years. But at the 7-year point, the position changes. So that actually at this point in time, all of the value of the FRT is considered outside of the estate for IHT purposes. You do get an increase in benefit for the DGT, but of course that's always going to be offset by the fact that you've got regular payments going back into the estate, which we're assuming aren't the case for either the FRT or the loan trust. And then you can see the benefit of the loan trust around about 11, 12 years, exceeding the reduction to the estate secured by the DGT. But obviously with this loan trust, we're assuming no payments are being made. And the critical point with the DGT is that it's worth considering for a client if they actually need the regular payments going back to them. If they don't, then maybe the FRT is going to be appropriate, or maybe the loan trust, depending on how the settler feels about which route to take. So this is kind of a final slide, and I've touched upon this already. I don't know the precise numbers, but certainly more than 90%, maybe just under 100% of the trust applications we get typically taken out with an onshore or an offshore bond. And there are a variety of different reasons for that. There's a lot of flexibility in using an investment bond. It's easy to assign into a trust, and that assignment isn't a disposal for capital gains tax purposes. It isn't an event either. It isn't a chargeable event unless it's for money or money's worth. Once the bond is inside the trust, then it's a non-income producing asset in the hands of the trustees. So it's not generating income or capital gains that need to be reported by the trustees. So it cuts down on the amount of trust administration that's required. In addition to that, at the point at which benefits need to be distributed to beneficiaries, then it's possible for the trustees to just assign as many segments are required to pay the beneficiary out of the trust directly to the beneficiary, so that the beneficiary can then make the encashment, and then any chargeable event gain falls on the beneficiary and not the trustees. So the trustees don't end up paying those higher rates of tax that would otherwise be payable if they were holding the investments in a GIA and suffering capital gains tax at 24%, or income tax on interest at 45%, and then the higher rate for dividends, 39.35% on dividends. They kind of avoid having to pay those rates of tax, and they avoid having to report the income in the first place. So that tends to be why that kind of flexibility and ease of administration tends to be why trustees do like using investment bonds. And on the platform, I think Ross has already mentioned that we do have our own onshore and offshore bond available. The cost for the bonds is slightly different. The onshore bond is around about £72 a year as the rapid charge. The offshore bonds, £240 a year. They are life insurance policies, not capital redemption policies, so you do need to specify lives assured. Trustees can also make use, of course, of the 5% tax deferred withdrawal limit, and that can be useful, as I mentioned earlier, if the settler requires regular payments. If it's a DGT or a loan trust, then the regular payments could be funded using the 5% tax deferred withdrawal, and that way there's no tax charge being arising immediately, although of course it is storing it up for later. So that pretty much covers all of the areas I wanted to talk about. So we've got about 10 minutes, so maybe we can use that 10 minutes to answer any questions. I'll stop sharing. Okay.
Stun them into silence, Mark.
I know, they're all asleep. That's what it is.
I'm awake, but I don't have any questions.
Oh, good, good. Well, hopefully that was all relatively clear. Of the various trusts I've spoken about, we offer specimen wording for a discounted gift trust. That's available on a bare or discretionary basis, as is our gift and loan trust. That can be bare or discretionary. We've also got a standard bare trust and a standard discretionary trust available. And I have talked about a flexible reversionary trust. We don't have it yet, but it will be coming very soon, certainly in the next couple of months. So I feel I'm stealing your thunder here, Ross, trying to sell the platform and our wrappers, but maybe I should be leaving that to you.
Carry on, Mark. Well, I was going to say, in the sense of follow-up, Mohan, I'll get the contact information from you. I'll send across the CPD certificate for today. But any wider kind of... Oh, there you go, Mark. We've got a question there. Final capital redemption option.
Yeah, it's an interesting question. He says, trying to buy some time. No, we did look at offering a capital redemption bond, and there are some kind of minor benefits in not having to select a life assured. But actually, what we found is that having lives assured isn't that big a deal. Typically, it's possible to have multiple lives assured with our bonds. I'm not sure how many lives assured, the most number of lives assured we've got attached to our bonds. I think for one of our offshore bonds, we've maybe got 8 lives assured attached to it. So it does give a fair amount of flexibility. And the feeling was we could develop a capital redemption bond, but it would just end up, it wouldn't generate a huge amount of extra business for us. It might just reduce slightly the interest in our other products. But we think that having them on a life assurance basis is sufficient. Perhaps not very satisfying answer.
Hi, Mark. I've got a question, if you don't mind, please.
Sure.
General trust related, particularly on the argument, forgetting IIP trusts for the minute, predominantly looking at discretionary versus bare or absolute. Where children these days, really, although they become adults at 18, we all know that they don't really leave home or become really, most of them anyway, mature until sort of mid-20s. Where is the argument these days for using bare and absolute trusts? Because if I'm not mistaken, the beneficiaries become absolutely entitled to them from age 18, and the trustees have a legal duty to inform the beneficiaries of said trusts. Basically,
Yeah.
just giving them the keys to the kingdom and nothing you can do about it.
Yeah, that again, a really good question. We do see bare trust being used for minors, but what we don't see is what happens in terms of communication between the settlor or the trustees and the beneficiary, whether and how strongly it's announced that they've got these benefits sitting in a bare trust for them. But we also see bare trust being used in conjunction with a DGT. And in those circumstances, the beneficiary's interest plays kind of secondary position to the rights to capital payable to the settlor. So we will quite often, I say quite often, we do see a number of DGTs set up on a bare trust where so you have the bare trust beneficiaries who are absolutely entitled to the trust property, but actually they can't have any of it because the trustees aren't going to distribute it until the settlor's dead, and they know that they don't have any ongoing liability to pay the settlor the capital payments. But you're absolutely right in terms of the beneficiaries do need to be notified by the trustees of the benefits, because they're, in theory, they're liable for the tax. I say in theory because, of course, if they're using a bond, then there's no tax to pay until it's surrendered or on death.
But having said that, you can't have a bond if you're under 18 anyway, can you?
Right. So if it's a bare trust, the trustees own the bond. You're quite right in the sense that an individual under age 18 can't apply for a bond. But a bond in a bare trust for the benefit of an individual, the legal title sits with the trustees and they can have a bond.
Oh, of course you can. That's why you assign segments into the bare trust to get around the assignment. No, of course you do.
Yeah,
So in terms of that element, I mean, the typical scenario I might see more of is grandparents, too much income, houses have all shot up in value, bit of an IHT issue now. What can we do to reduce it? Oh, we can gift it to the kids or at least start to see them enjoy it in their lifetimes. And so you start talking about how we look to gift to grandchildren or children, whoever, and you start talking JISAs, junior pensions, bare trusts, and what have you. What is the sorry, so the point of that then it might just be a little bit of gifting out surplus income from their DB income or whatever it is anyway, which of course isn't so much of an issue. But what is the minimum really required when they don't really want them to have access at 18, but they don't want to use discretionary trusts or anything that might incur a CLT or potential CLTs and other reporting? They're really just trying to keep things simple, use a bare trust, but without just having the trust that the beneficiary is going to take it all at 18 and go and spend it on a holiday to Ibiza or buy a car or some silly purchase that I know the grandparents wouldn't want.
So when you say the minimum, what
So really, what is the absolute minimum expectation in terms of the settlers to inform said beneficiaries about it? And what's how can you dance around it if basically tell them but without telling them?
Yeah, I'm not sure what the what generally happens there. I've got a feeling that across all of the bare trusts we have on the platform, there's probably a range of different approaches taken, from giving them barely any information because there's no tax liabilities, or suggesting to them that there is a trust set up for their benefit and it'll get paid to them at some future point without being explicit
Of course,
about the
if they're
amounts.
investigating that and demand it, then they've got their right to.
Yeah,
But most
absolutely.
ordinary 18-year-olds probably wouldn't. Okay.
But I imagine also that there are other trusts set up where the beneficiaries are told completely about the investments that are being held for them, and they're just quite happy for them to sit within the trust. I know if it were me and I was turning 18, I'd be on that flight to Ibiza.
Well, that's the thing, isn't it? Most ordinary,
Yeah,
a bear trust is
yeah,
perfect when you've got that mutual respect with
mm,
grandchildren or children that can, you can amicably agree that this is for your future and you can't touch it. But it's all those other ones then that you've got a bit raise an eyebrow, or you set it up when they're young and innocent, and then they might
yeah,
go through that period in their later teens, and you start
yeah,
questioning then, oh, have we got a problematic one here? Or they might. So I've come across cases where they've turned to drug dependencies or had alcohol drinking or just become estranged or whatever it is.
yeah,
So whilst you've set it up with good intention, I just curious. I mean, obviously the answer to this is discretionary trusts, of course.
yeah.
But it just makes me wonder in what scenarios these days, other than from the tax perspective of it being pets over CLTs and reporting and what have you, where bear an absolute win.
It's really tough, isn't it? Because so much of it depends on what the individual beneficiary might do, which is hugely unpredictable. But you're right, you know, if there is a genuine concern and a genuine need for flexibility, then the only real solution is using a discretionary trust,
Yeah.
which won't always be appealing for sure.
Okay, brilliant. And sorry, just lastly, just to, I hope nobody else has got questions and I'm stealing the thunder, but could you just briefly run designated GIAs, please, and how they
Yeah,
work? Because again, the
yeah.
same scenario where you can gift out a surplus income into that, but what's the positioning on those and how do they really work?
Yeah, so in order for the gift to be effective from a kind of tax perspective, it needs
Yeah.
to be irrevocable.
Yes, of course.
Okay, and that can be done with a letter, and it can easily be set up on our platform because you can create, you know, a sub GIA and designate it in favour of whomever you like. We don't do, if you call a sub wrapper Mickey Mouse, that it's just a label you're giving a sub wrapper. We don't make any inquiries about that. But what I would say is, though, I would steer clear of using designated accounts because you still have all the problems surrounding trust registration with a designated account set up with an irrevocable gift that you'd have from just creating a trust.
Because you are essentially verbally effecting a trust and holding it on trust for the designated beneficiary
Yeah,
then.
yeah. So it doesn't, in my mind, I mean, what we tend to say with the platform, using our platform, is if you're going to make a gift, create a trust, have it all recorded accurately. You can set up a trust portfolio on Transact and manage the investments. All of the reporting then is right. We'll make sure that the trust is registered before we'll bully you into registering it before we'll accept it onto the platform. And that way we can be sure the trust is set up properly and all of the relevant reporting is being done to the regulatory authorities under the right names. With a designated account, if a customer's got their own assets in a GIA plus assets in a designated account, we break out our tax reports between the two different GIAs, but we have to report at portfolio level all of the income that's being generated. So, for example, interest income will be reported automatically to HMRC based on the total that's in the portfolio, not broken down between a GIA for the portfolio holder and the sub-wrapper Mickey.
Sure.
So from a reporting perspective, we would always suggest using the trust approach and setting up the trust account and avoid using the designated GIA approach.
Brilliant. Helpful. Thank you very much.
Long-winded answer, sorry.
No, I appreciate it. Thank you.
Okay, well, thanks for the questions. Are there any more? Let's see, we're at 11 o'clock now. Okay.
Excellent. Well,
All
thanks for
right,
your time, guys. I'll say, and I'll,
Yeah, thanks.
I'll get in contact with you for some follow-up for contact details and things. But hopefully, I'll give you some food for thought surrounding some of the areas we can support you in going forward. But if there's any areas that are in demand, Mohan, further into 2026, please let us know, and we can we can run another one of these if demand's there for you. No
That'd be
problem.
fantastic. I was going to say, Ross, I've asked the advisors to put their email address
Yeah, got those
in the
No
chat,
problem.
so you can just send the CPD certificates directly to them,
Sure.
if that's all right
Yeah.
with you
Okay.
guys.
No, that's no. I'll do that for the CPD for today. Yeah, and then in terms of wider contact, I'll reach out to you for that if that's all right.
Okay, yeah, that's perfect. Excellent.
To,
Thank you very much.
okay.
Appreciate your
No problem.
webinar.
Thanks for your
It's been
time.
very informative.
Cheers,
Thank
mate.
Thanks,
you.
Moan. Cheers now.
Cheers.
Bye-bye.
Bye-bye now.
Thanks, mate.
Bye-bye.
Cheers.
Bye.
Bye.
Bye.